From a regulatory crackdown that wiped out billions in value to a quiet, off-the-radar grind, DiDi Global has been one of the most controversial and talked about stocks in recent years. But today, we're seeing headlines that point to a massive turnaround. The question on every investor's mind is this the comeback story we've been waiting for? Now, before we dive in, the disclaimer is crucial. This video is for educational and informational purposes only. It is absolutely not financial advice. Investing has potential dangers, and you should always do your own extensive research and consult with a certified financial advisor before making any money decisions. My goal here is to break down the numbers and the story so you can be better informed. Alright, with that said, today we're doing a deep dive into DiDi Global's second quarter 2025 earnings report. We'll look at the good, the bad, and the ugly. Is the trend for DiDi looking green for go, or is it still flashing red for caution? Let's find out. First, for those who are new to the story, who exactly is DiDi Global? Think of DiDi as the Uber of China. It's the dominant ride-hailing giant in the country, but it's much more than that. Its operation is split into three main parts. China Mobility. This is their core operation, the ride-hailing you know and love, right in their home market. International. This is their big growth engine, with operations spreading rapidly across Latin America and other emerging markets. And other initiatives. This is their playground for future growth, including bike sharing, auto solutions, and other financial ventures. DiDi is a massive player, and its performance tells us a lot about the tech scene in China and the global ride-hailing industry. So, let's get to the main event, the Q2 2025 earnings. At first glance, the numbers are confusing. Revenue came in strong at 56.4 billion yuan, up a very healthy 11% from last year. But then you see the headline net result, a net loss of 2.5 billion yuan. Hold on, this is the most important part of the entire report. That loss isn't what it seems. It was almost entirely caused by a one-time, non-operational charge of 5.3 billion yuan. This was a provision to settle a major shareholder lawsuit left over from the drama a few years ago. Here's the catch. If you remove that one-time legal cleanup cost, DiDi's core operation was actually highly profitable. Think of it as finally paying off an old, massive debt. It hurts the bank account today, but it cleans the slate for a much healthier future. This report is a classic case of the headline number hiding a much more positive story about the company's actual operational health. Let's break down where that 11% revenue growth came from. The engine of the company is something called Gross Transaction Value, or GTV. It's the total value of all the rides and bookings on their platform. Total GTV grew by a strong 14% year over year. Now, let's look at the two key segments. China Mobility. The home base grew its GTV by a solid 12%. This is very important because it shows that even with heavy competition from rivals like Meituan and Alibaba, DiDi is defending its turf in its most critical market. And here is the star of the show, the international division. The international segment saw its GTV skyrocketed by 19%. Daily international transactions were also up an impressive 25%. So, what does this mean for you, the investor? This international growth is a massive factor in lowering the company's overall danger profile. For years, the big fear with DiDi was its total dependence on the Chinese market and its regulators. By expanding abroad, DiDi is building new, high-growth revenue streams and reducing its reliance on a single market. That is a strategically brilliant and vital move. Okay, so revenue is growing and diversifying, but is the company actually making money from its core work? Absolutely. We already talked about how the net loss was misleading. The real story is in their adjusted profitability metrics. DiDi's adjusted EBITDA, that's a key measure of core operational profitability, surged by an incredible 97% year over year to reach 2.5 billion yuan. Let me put that in simple terms. For every dollar in revenue they bring in, they are becoming much, much better at turning it into actual profit. This isn't just growth for the sake of growth, it's disciplined, efficient, and profitable expansion. The report also mentioned solid operational cash flow, meaning the company generates enough cash to fund its own growth without needing to borrow or raise money urgently. This is a sign of a healthy, self-powering company. So, with that data, let's review the company's profile. We'll begin with the key advantages and the main challenges. On the positive side, first and foremost is market dominance. In China, DiDi is king. Its massive network of users and drivers creates a powerful advantage that's very hard for competitors to overcome. Second, as we just saw, they have strong core profitability. That 97% jump in adjusted EBITDA proves their model is highly efficient and can scale up. And finally, international diversification. This is their strategic escape hatch and their biggest growth story. But we have to be realistic about the downsides. First, legal and regulatory hurdles. While the big lawsuit is settled, that 5.3 billion yuan charge is a clear reminder of past governance concerns and the potential dangers that remain. Second, they still have a heavy domestic market reliance. Even with international growth, China is the main driver, making them vulnerable to economic shifts or aggressive competitors at home. And third, their delisted foundation. Not being on a major exchange like the NYSE limits entry to capital and keeps some large investors away. So let's get to the forward-looking part, future potential and major headwinds. The biggest growth path is clear: continued international expansion. Markets like Latin America are ripe for growth, and DiDi is already proving it can win there. Another huge opportunity is a potential relisting. With their finances looking much healthier, a relisting on an exchange like Hong Kong is a real possibility. This would be a massive catalyst, unlocking major value for shareholders. On the other side of the coin, we have the clear dangers. First, heightened government oversight in China is not going away. New rules on data and platform operations are always a possibility and could increase costs. And second, fierce competition. We saw DiDi's rival Meituan recently report a massive 89% drop in its profits because of a brutal price war. If a new price war erupts in ride-hailing, it could badly hurt DiDi's margins. This is a constant factor that investors must watch closely. All right, it's time for the final analysis. Based on everything we've seen, is the trend for DiDi green or is it red? Fundamentally, the underlying operational trend is unequivocally green. The company is firing on all cylinders. The legal settlement should be seen as a positive, a final cleanup of past trouble. The core operation is not just growing, it's becoming far more profitable, and its international expansion is a game changer. However, the outside environment is firmly in the red. Government oversight, heavy competition, and global friction are all part of the package when you invest in a major tech company from China. These are factors you cannot ignore. So, what should retail investors consider? It all comes down to your personal comfort with volatility. If you are a long-term holder and you are comfortable with the global backdrop, the narrative here is powerful. The company's operational footing is quite good, and expert outlooks predict earnings could grow over 30% per year. For that type of portfolio, the company's strong fundamentals and growth potential could be a compelling fit. A short-term trader might see the volatility as a key factor, perhaps waiting for a clear catalyst announcement before getting involved. And for an investor who is cautious, with a main focus on protecting capital, the regulatory and competitive unknowns might present too much uncertainty for their comfort level. So, my final analysis is this: DiDi has demonstrated a powerful operational turnaround. It's a company with strong fundamentals and a clear growth path. However, it operates at a market with unique and significant risks that each person must evaluate for themselves. So there you have it. DiDi's Q2 earnings show a company making a powerful operational comeback, but it's still navigating a very complex and demanding environment. The cleanup of its legal past is a huge step forward, but the path ahead will require careful execution. What are your thoughts on DiDi? Is it a great opportunity or a trap? Let me know in the comments below. And if you got value from this breakdown, please hit that like button and subscribe for more deep dives into the stocks that matter. Thanks for watching.